Recorder is going. So this is our continuing dissection of our triple Q position, and I'm going to turn this into a little game for everybody. Okay, but first let's get some new statistics up on the board. Okay, this morning, if you recall, we were looking at the 164, 167, 170 butterfly that we have. Okay, with the triple Qs trading up around 165.75. Okay, they've now fallen about $1 since then. So what I'm going to do is lock in, so we can dissect it here, lock in a price of 164.60 and the price of the butterfly trading $1. Okay, that's what we're going to use as our basis. Fair? Everybody on board with that? Okay, so this is 12, 13, 18. Triple Q, deal or no deal. Okay, so Qs are 164.60, are 164, 167, 170 fly expiring tomorrow equals $1. All we need to know right now. Not all we need to know. Okay? But what should be the first thing we should look at to determine whether we want to hold this till tomorrow or not? Okay? Don't know whether that's the first thing, Ken, but it's an important thing. So, intrinsic value is currently what? How much is the intrinsic value, everyone? Right here, right now. Okay, 60 cents. So that means right now, the extrinsic value, or premium, is how much?
Let's get to our day trade now with Mike Shore of Prosper Trading Academy. And before we get to your
okay, 40 cents. Good. Okay, what should be the next thing we should look at? Okay, at this point, David, how much we paid for it is irrelevant. What we're trying to do is determine an expectation and a fair price, a fair deal, great, for what this is going to be tomorrow. So great. Don and Alan, more so Alan, that's what we need to look for. Okay? So what is the market's expected move until end of day tomorrow? Okay? That expected move, let's just look at the 164.5 straddle. Again, this is a fast moving market right now. The 164.5 straddle is about $2.40, and that's 25 cents in the money. How are you guys coming up with 58-cent expected move? That's not what Thinkorswim says. That's today, right here, if you're looking at that, Ken. We're looking at tomorrow. $2.50 is their calculation. This expected market maker move is for today. This is for expiration tomorrow. Okay, our calculation, which now we're at one, we have to just pick a spot here. So now we're at 165. So the expected move is really right about $2.40. Okay? So that answer is $2.40. Now remember, that expected move at any one time that the market is pricing in, okay, is calculated with a 1 standard deviation probability. Okay, so the expected range, not where we're going to end up, the expected range between today and tomorrow is then, let's call it 162.20 up to 167. With a 1 standard deviation or 67% probability. Everybody with me? Now we can start breaking things down into what the probability of the expected value of this butterfly will be tomorrow. Okay? So, if we take the two extremes of what the expected move is, okay, we take the two extremes. At 162.20, the value at end of day tomorrow will be what? Yep, it will be 0. Okay? At the other extreme, at 167, the value at end of day tomorrow will be exactly the absolute max that it could be. $3. Okay? Anywhere else in the middle, we're going to have a different value. Okay? So break even is 164.40. which is the long strike of 164 plus the debit that we paid. Where's the break even on the upside? Because there is a break even on the upside as well. Anybody? Great. Ken, Alan, awesome. Awesome. Yep, that is correct. That is 100% correct. Okay. William, when you say lose value from where we are right now, or lose value from where we paid what we paid for the spread? William? We're not looking at that, William. We start losing from the max value of the spread anywhere above 167, not just above 169. Above 167, we start losing from the max value. But the break even from where we paid 40 cents for this spread is 164.40 to the downside, 169.60 to the upside. No, Ken, it's not 169.80. Should we do the math? Okay. At 169.60, the 164s are worth how much? The 164s are worth how much at 169.60? Okay, 560. Everybody see that? Everybody agree with that? And how much are the 167s worth at 169.60? Okay, 260. So what's the value of the butterfly? Remember, there are two of those. There are two 167s. So what is the value of the butterfly? Exactly. Subtract 520 leaves us with a value of what? $0.40, which is what we paid. That's our break even. Does that make sense now, Ken? Okay, good. All right. We've got all this data on the board now. We've got our break-evens. We've got expected ranges. So now what? If we were purely playing a game based on probabilities, now what? What is the probability? What is the expected value what is the pure expected value then of this scenario, right? If we want to truly break this down from a mathematical perspective, which is exactly what they do on the show Deal or No Deal, based on the suitcases or briefcases that are left with the amount of money each briefcase is worth. But the house there always gets an edge, so they're never going to give you the fair value. They're never going to give you the fair value. You don't have to, Michael, because we're already calculating that only 67% probability of the move in this range. So that will cause the 33% outside of that move, where it's going to be worth 0, to already be calculated in. So here's the way that I would do this. Okay? Here's the way I would do this. 67% chance that the value will be worth 0. Right? Everybody see that? Because if we go to 162.20, the value is 0. So this is going to be continued here. Okay, so is everybody with me so far? I want to take this step by step. I don't want to lose anybody. Okay. We also have 67% chance this will be worth $3. Okay. We then have some possibility of this being $0 to $3. Okay? Everybody see that, right? So we have some possibility of this being worth $0 to $3 if it closes anywhere in between 164 and 167. Everybody see that? Okay, so what is that possibility of this being worth $0 to $3? Well, it's not. It can't be 100% possibility, Don, because we're saying that there's a 67% chance it's going to be 0 because it's going to be down at 162.60. 67% chance that it's going to be worth $3 because that's the move to the upside. So there's a 33% chance that it will be in the middle somewhere. Okay, what would be the average price that's in the middle? Exactly, Ken, right? If someone were to say to you, there's an equal chance this is going to be somewhere between $0 and $3, then the average price of that is $1.50. Okay, so then there's a 33% chance that it'll be worth $1.50. Well, Richard, if there's a 67% chance, and it's actually not quite 33, but if there's a 67% chance that it's going to be worth 0 because the stock is going to be down at 162 and change, I am. And there is a 67% chance that it's going to be worth $3 if we're expecting it to go to one end or the other. Then that leaves a 33% chance that it's going to wind up somewhere in the middle. You're right about the curve, Richard. You are right that this is a normal bell curve, okay, with this area right here being one standard deviation, which is 67%. Okay, you're 100% accurate with that. But what we are saying is that there's a 67% chance it's going to go there, or a 67% chance that it's going to go there. Not in the middle. We're saying a definitive point of here or here. Okay, so we're not saying that it's a 33%. We're saying 67%, it's going to go either here or here. And now that I'm looking at this, and this is great, Richard, this is great. Now that I'm looking at this, I agree with you. I agree with you. Okay? The 67% chance is that it goes either here or here. Meaning, that if you isolate one of those, it's actually 33.5% chance it goes there, 33.5% chance that it goes there. So I totally agree with Richard here. And that is my error, because we are looking at one or the other, not the entire range. So that's actually 33.5. This is actually 33.5. Okay? Now, that would leave not quite 67, because remember, we also have the outliers for the Uber 2 standard, 3 standard deviation move. But let's just keep it simple at adding up to 100% right now. Okay? So this would make somewhere in the middle, being worth a 67% chance. Thus, 67% chance of it being worth $1.50. Does that make more sense now, Michael and Richard? I know it does to you. Does that make more sense to everybody? Okay, so let's add up the probabilities now. Okay, if we have a 33% chance it's going to be worth 0. Andre, they do, because this 33.5 is either or. It's not both, it's either or. One or the other is going to happen. So if this happens, this doesn't. If this happens, this doesn't. So it does add up to 100. These both can't happen. Both of the 33% can't happen. Okay, so if we take then mathematically the probabilities here, we have a 33% chance of 0. Okay, we have a 33% chance that it's going to be worth 3. So the expected value of that, 33% of a $3 number, the expected value would be $1. And let me label this up here. Expected value. Okay, we then have, from this last set of possibilities, a 67% chance of it being worth $1.50. So $1.50 times 0.67 is $1.101. Okay, everybody with me? So what do we come to mathematically based on this? of an expected value. These are all equal expected values. So I believe if I'm doing this correctly, and we have a third of a chance it's going to be worth 0, a third of a chance it's going to be worth $1, and a third of a chance it's going to be worth $1.01, then we would take that total expected value. Each of them have a third of a chance. And I would look at it and say, right here, right now, the expected value of this thing is 67 cents. That's the way I would look at it. Now, that's the pure mathematics way of looking at it, if I'm doing this right, and I think I am. There's obviously so many other factors that go into this, right? Volatility being probably the top factor that can affect this equation. But if I were in the situation of deal or no deal right now, from a pure mathematics standpoint, and currently, I mean, now again, Q's have moved from where we've started evaluating this. Let's say this thing is trading 95 cents right now. Okay? Based on this whole entire mathematical calculation, what would you do? Well, we already closed half of it, Tim, right? We already closed half as a risk management decision, closed half for 75 cents or whatever it was the other day. So these are obviously other dynamics that factor into the expected value. Okay? And remember, that expected move that we're seeing now for tomorrow, that's going to be lower by the end of the day today. Which that would also then increase the expected value of what this were to be worth. Well, William, I would for sure sell it at that price. We haven't even gotten there yet. Hasn't traded anywhere near that price today. But remember here, again, all of this math up here does not take into account Greeks, theta, volatility. Okay, so there's more that goes into it. There's more that goes into it than just pure mathematics. So, Don, I would disagree with that because, again, what do we always talk about with butterflies? The nature of butterflies. What do we always talk about? That's how butterflies work. The premiums don't come out till those last day or two. Exactly. All that needs to be factored in. So, I'm asking all of you. I'm going to put a poll up on the board. No, right now, Don, right now it's worth $1. If we could have the crystal ball and say tomorrow end of day, then yeah, it's only worth, well, right now 60 cents. Okay, so I'm going to put a poll up on the board here. Okay, based on our mathematical analysis of our QQQ butterfly position and the expected value we calculated, where would you cash out right now? Okay, there you go, guys. Have at it. Those are your choices. Well, Michael, sure I did. Absolutely I did. Because what's it trading right now? It's trading 95 cents right now. So that falls in one of our categories. Got it. And Mary Jo, that's the answer to that question. Or, I probably should have added one more on here, but it's too late. Would you just cash out for a bottle of Goose? Now, Michael, maybe that's the best answer of all. Okay, I'll leave this up here for another couple minutes. So far, the results are just like an exam, you know, just like a regular standard bell curve. Pretty darn close. When you say percentage, Richard, are you talking about the expected move? Well, if this is what I think you're asking, what I'm looking at right here is D's 14th expiration, $2.49 is the expected move. Okay, and then, so if you want to go out and look what it is per expiration cycle, go out a further week to D's 21, and right now the expected move on Thinkorswim is $5.46, going out that extra week. So on and so forth. Okay. Are you seeing something different, or you're just not getting that at all, Richard? Okay. Yeah, send me a screenshot. Okay, yeah, just send me a screenshot. I'll be glad to help you. Robert, I like that. All right, I'm going to stop the poll here. Let's take a snapshot of that. Today is the QQQ deal or no deal poll. Shabte, what's 13? Richard, I don't have it yet unless it went into spam. Let's see. Oh, it did. Look at that. Let me mark that not spam. All right, here we go. Oh, wow. It's... You don't have the Qs up there, Richard. That's why. You're looking at the diamonds. You don't have the QQQ up there. From what I'm seeing, from the screenshot you sent me. Yeah, so put up the Qs and send me that one. Okay, let's take a look. There we go. Now you're not in spam. Now you're spot on, Richard. Now you got exactly what we had, $2.48. So I guess I'm not understanding what you're asking, because I see the exact numbers to what my platform has. 248 for this week and 544 for next week. Do you see that, Richard? That net change that you're looking at, I can put it on mine right here. Let me do this. Okay, the net change you're seeing right there, which mine doesn't say net change, but yours says it right here. That's the net change on that particular option for the day. That doesn't have anything to do with these numbers right here.